Overall, what sense do you get for global economies right now, or markets? I mean, do you think it's one of those phases where economies have started doing well and we can get into 2, 3, 4 years of decent growth? I mean, markets will do better and worse, but mostly move in one direction?
I think it's more to do with intrinsic value of market growth. So I think, let's put it this way, most of your questions have been on macro related. So if you allow me, I will just make this conversation a little bit more interesting.
Sure.
So let's play it this way, okay? I will give you 5 or 6 scenarios, and that will likely play out as I forecast. And you are the investor sitting out there.
Okay.
And the only condition you have is on first day of the year you will invest, and the last day you have to close your positions. Okay, and let's take the closest year, which was 2016. Okay. So in January 2016, I give you about 5 or 6 conditions that Fed rates will perhaps go up by only 25 basis point in the entire 2016, because in December 2015 we saw 25 basis point hike, and everybody by and large was talking about 75 to 100 basis point hike.
Right.
The second condition I'll give you is market will tank by about 20% in the next 2 months in India.
Okay.
Third, I will give you a condition that Raghuram Rajan will no longer be continuing as Reserve Bank of India governor. There are no talks in January 2016.
Correct.
And then I'll perhaps give you another thing, that Brexit will surely happen. By and large, Brexit wasn't an event.
No.
Then moving forward, I'll give you 2 more incidents, that Donald Trump would be the president of the country, United States. He wasn't even a presidential candidate in the month of January.
Correct.
And the last of all, and the biggest of all, is demonetization will happen. So if you are having borrowed funds on the 1st of January, what will likely do? Most likely situation.
Short.
Completely, right? Even perhaps borrow money and short. And
sell
on 31st December, sorry?
Sell my house and short.
So on 31st of December, if you look at Nifty, it was slightly positive or flattish. So it's getting incrementally more difficult that even macro conditions which we hear and which are likely to play out, the result may not be so much, in the stock market. And that we are finding it more and more, at least I'm finding it more and more. So the best thing is to do is play bottom up. And that's where you find a lot of good companies, good models which have sustainable earnings growth.
That's a terrific point, but therein also lies the challenge, because bottom up right now, getting into some valuations which one can see, you will have to take a time leap that I will buy at 35 PE and be prepared to wait for 2 years for this earnings to level out these kind of valuation levels. Do you find it challenging to take that kind of leap as a fund manager, the valuation leap?
Absolutely, without a doubt. So earnings, why they are trading at this valuation is also a result of, while other opportunities are not available in the market for investors, or they have disappointed on earnings growth.
In terms of asset classes or sectors which have disappointed?
I would say company specific and sector specific, not asset classes so much. So if earnings story derails in the stocks which are sitting on high valuation, you will find significant amount of corrections happening. So a company has to keep on justifying the valuation at which it is trading at any point of time, and more so when it is at premium relative to the past or peer group. So that obviously will play out without a doubt. And that's where I think the more bottom-up stock picking thing comes up, that how well you understand the company compared to rest of the market.
What is your bigger fear when you buy something which is relatively expensive in your book? That the stock might derate if there is any earnings compression or earnings disappointment, or that because of the high valuations you're playing, maybe for 2-3 years the stock goes flat? The stock needs to catch up for the high valuation that you've paid for it.
Absolutely. So I think, okay, let me just give an example. Telecom sector per se, right? This is a good sector to talk about, in which valuations plus earnings have been talked about in terms of narratives. And so I may be in the minority, in terms of how people have been judging this sector. But look at the last 7-8 years. There are 3 stakeholders in this whole ecosystem, right? One is government, second is shareholders, and third is consumer. So in the last 7-8 years, government has made money. Consumers have made money because they are getting at reasonably lower tariff, but shareholders haven't. Now something is amiss in this whole sector. So somehow, if you look at a consumer company in which the raw material prices go up the company has a decision, can make a decision to increase the prices to protect the margins. But somehow this is not happening in this particular sector. Costs are going up. For some reason, they are not able to pass on. And there is some structural issue, so they don't have the pricing power. Now, if you look at the largest company in the sector in the last 7-8 years, the top line perhaps has gone up by 2.5 times, right? Operating margins or EBITDA, whatever you call it, has perhaps followed similar suite. But profitability in the last 7 years has down by half. So this is a story of the leader of the pack. So how do you rate the valuation? 3 years back, if you said, no, valuations are looking cheap because someday earnings will catch up. But that didn't happen. And obviously the stock market will behave based on how the earnings have grown. So it's a little bit of pinch of salt. You need to take it with, where the earnings are growing, how solid the business is, where are the disruptions coming from. I personally look at all those things, not rather than just a valuation call that it's just expensive, so not touch it at all.
Since you mentioned telecom, do you think it's about to change after 7 years? Or you can't take that call even right now?
I am finding it difficult to get the numbers added up to me. The new player coming with really deep pockets is more disruption ahead of us. I think need to wait for some more time. I'm still not able to make the call at this point of time.
Fine. Let me switch this to a different sector, which is basically a sector which a lot of people think has to use the parlance used in the stock market, a huge runway of growth, which is building materials of any kind, paints, ceramics, tiles, electricals. Valuations are very expensive again, 40 times, 50 times, 35 times. Can you take that leap, or do you think something like telecom can happen in that space as well, compressing the time period or the valuations?
So that's the point which I mentioned. The sector telecom per se somehow doesn't have a pricing power. I'm not talking about India alone. I checked out companies across the region. Barring 1 or 2 players, others are actually not making money. The investment in 3G, which has gone in 2008-9, still haven't returned money in terms of ROIC. Something similar is likely to happen in the spaces which you just mentioned or segments. Obviously, it's a worry. But at this point of time, penetration is low. At least the model seems to be reasonably strong. And earning sustainability without any major disruption continue to look okay at this point of time. So that's a reason we think, and plus all the initiatives government has taken, I think the results will start bearing fruits in the next couple of years.
Okay. Now, your point about not being able to pass prices down, like telecom, was the case for a sector like oil marketing companies, but that changed. And probably with that, we saw a derating or re-rating of that sector. I know you own some oil marketing companies as well in your portfolios. Is it good to go even from here? Like, have you seen anything in how the government is behaving to alarm you in terms of those suggested mergers with upstream companies, etc.? Or would you keep the faith with oil marketing companies today?
So the merger is a new thing which is just announced in the budget. So I don't know in what way it will play out. So perhaps wait for some time. The other point here is, will government intervene in terms of the subsidy management at this point of time? And if the crude goes to whatever, 60, 70 levels, that would be perhaps the first test. But around 50, 54 levels, we have seen there has been no change in the policy. And understanding from the government so far, at least last 3 years, makes it very clear that they are more into empowering rather than providing entitlements. So at this point of time, I think I would play by that this will be non-disruptive at least in the near future.
Do you like any Indian exporters? Because that's a space which has got punished over the last couple of years, last year particularly, pharmaceuticals, IT, or are you underweight in that space?
IT, surely we are underweight. Pharmaceutical, I think it's coming back with 2 years of, and they had a fantastic 5 years run from 2000 to 2015. So you have to give a little bit of, a fatigue thing out there. But I think this FDI issue seems to be slowly waning off. So once that and growth comes back, there are still some good models, domestic as well as US-based generic space. Pharmaceuticals should do well.
What about chemicals? Any exporters there that you like? Do you like that space overall from India?
Not much. Not much on chemicals.
Okay. So your preference is for domestic-oriented plays?
Absolutely.
You have a domestic-specific fund as well, do you?
Yes, we do.
What is it called?
The India Equity Fund.
which is largely domestic focused.
Yes,
So you would own a lot of auto companies there.
that's correct.
So two-wheelers, commercial vehicles as well, or largely four-wheeler based?
So we have two-wheeler as well as four-wheeler in that. Commercial vehicles is to that extent quite less, or hardly any at this point of time. But we are, let me put it this way, the focus is more, if you look at the Indian economy, there are three pillars, which is consumption, manufacturing and exports, right? Consumption is 2/3 of the economy, and balance 1/6 each is manufacturing and exports. So we are quite optimistic about the consumption leg of the economy.
Okay.
And which for us it includes basically B2C. So it's just not a categorization of staples or discretionary on the consumption leg. So any B2C which seems to have a good model, we are pretty optimistic about that. So it could be in the industrial space, or it could be in the material space, and also the retail finance model which we just spoke about. All these spaces I think should do well in time to come.
What about anything to do with capex? Because that's languished again for the last many years. Do you think with an earnings turnaround, maybe next year we start to see things pick up, or is it still in the realm of hope?
Balance sheets there are still an issue. See, everybody expanded capacities by funding their balance sheet through debt. So they are still sitting on over leveraged balance sheet, and utilization is still about 65-70% or so. So when the demand is not picking up as we are seeing it, how else are they going to repair the balance sheet and improve the cash flows? So till demand improves in that space, they will first try to improve the balance sheet and then start providing for the growth capital. So I think it will take a little bit more time.
So you're not terribly optimistic or overweight on that space now?
Where balance sheet issues are there, obviously we are not touching those companies at this point of time.
Okay, let me ask you about the general mood, global mood towards emerging market investing right now, because last 2-3 years, I mean, I heard from so many people it's getting difficult to raise money, people are disappointed, their faith in the asset class is not what it used to be. Is it slowly beginning to turn around, or is it just a factor of the recent momentum in stock prices in this part of the world?
Growth looks like slowly coming back with a, whatever last year was 4.7, 4.8, this year should be slightly higher than that. That's what the predictions are. Some economies started doing well in emerging markets. One was like, the commodity producing and commodity consuming sort of those split which we had in the past. So growth seems to be slowly improving out there. So this year and next year, hopefully if global growth improves, because those are the consuming market and these are producing markets, they should start doing well.
But what is investor sentiment and positioning like towards emerging markets now? Still mildly skeptical, or are you seeing the return of money to this part of the world?
Money is coming slowly, but trickling in, let me put it this way.
Redemptions have stopped?
Yeah, surely. Redemptions have eased out after December. In the last 2 months, we have started seeing inflow coming into the funds.
Even in country-specific funds, or is it a broadly EM-oriented investment now?
You'll be surprised, even country-specific, we have started getting good, decent inquiries. Even in India, I would say. So, by and large, people say it's coming on the regional allocation into India. But for us, we are seeing some amount of trickling in interest surely appearing in country-specific funds.
Okay. On that optimistic note, I shall thank you. Shekhar, it's been a pleasure. Thank you very much for your time.